Welcome to the COO's office. For the past few weeks, we were locked in the CFO's room. It was a cold, quiet place filled with calculators, tax codes, and risk assessments. We built a fortress to protect your capital. But you cannot win a war just by sitting in a fortress. Eventually, you have to open the gates and march out. You have to conquer territory. In the corporate structure of U Inc., the chief operating officer, the COO, is the general on the field. The COO is responsible for strategy, for market analysis, and for research and development. The CFO asks, can we afford it? The COO asks, is it worth buying? Today, we begin Module 3, Market Analysis and Item Selection. The stock market has thousands of listed companies. In the US alone, there are over 6,000 stocks. Globally, there are tens of thousands. How do you choose one? It feels like looking for a needle in a haystack. Do you just close your eyes and pick? Do you listen to a random tip from a taxi driver? Or is there a systematic way to filter the noise and find the gold? There are two major schools of thought in the investing world, two different religions, if you will. One looks from the sky down to the earth. The other looks from the dirt up to the sky. Today, we are going to discuss the top-down versus bottom-up approaches. Let's start with the top-down approach. Imagine you are a surfer. You are standing on the beach with your surfboard. What is the most important thing for a surfer? Is it the board? Is it the wax? Is it your technique? No, it is the wave. If there are no waves, the best surfer in the world will just float in the water. But if there is a massive tsunami, even a mediocre surfer will travel fast and far. The top-down investor is a surfer. They don't care about the individual company yet. They care about the wave. They look at the macro. They ask big questions. What is the Federal Reserve doing with interest rates? Is the economy growing or shrinking? Which countries are rising? What is the next technological revolution? For example, a top-down investor looks at the world and says, the population is aging, healthcare demand will explode. Therefore, I will look at the healthcare sector. Or, they say, artificial intelligence is the new electricity. I must own semiconductor stocks. They start with the economy, then narrow down to the sector, and finally, they pick the leading company in that sector. Their logic is simple. A rising tide lifts all boats. Even a mediocre company will make money if it is in a booming industry. Conversely, even a great company will struggle if the entire economy is collapsing. Now, let's look at the other religion, the bottom-up approach. Imagine you are a treasure hunter with a metal detector. You are walking on the beach, you don't care about the waves, you don't care about the weather, you don't care about the ocean currents. You are looking for diamonds buried in the sand. The bottom-up investor is a treasure hunter. They ignore the macro. They believe that great companies can survive any economy. They don't look at interest rates. They look at the product. They look at the store. They look at the customer loyalty. They ask specific questions. Does this company have a product that people are addicted to? Is their profit margin increasing? Is the CEO honest and capable? Is the stock price cheaper than its true value? This is the method made famous by investors like Peter Lynch and Warren Buffett. They find a business they understand, maybe a coffee shop, an insurance company, or a soft drink maker, and they analyze it deeply. The bottom-up investor says, I don't care if the economy is in a recession. People still need to brush their teeth. This toothpaste company is profitable. It has no debt, and it pays a dividend. I am buying it. Their logic is simple. Cream always rises to the top. A truly superior company will outperform the market eventually, regardless of the macro environment. So, which approach should the COO of U Inc. use? If you only use top-down, you might buy a terrible company just because it is in a hot sector. You might buy a dot-com stock in 1999 just because internet is the future, and then watch it go bankrupt. If you only use bottom-up, you might buy a fantastic company in a dying industry. You might buy the best typewriter manufacturer in 1990. It was a great company, but the wave of computers wiped it out. The smartest COOs use a hybrid approach. They use the top-down method to find the wind and the bottom-up method to choose the ship. Here is how U Inc. applies this. Step 1. The macro check top-down. Look at the weather. Are interest rates rising? Is a recession coming? If the storm is too strong, we hold more cash. If the sun is shining, we deploy capital. Step 2. The megatrend identification top-down. Where is the world going in the next 10 years? Is it AI? Is it green energy? Is it biotechnology? Identify the sectors that have a tailwind, the wind blowing at their backs. Don't fight the future. Step 3. The best-in-class bottom-up. Now that you have chosen the sector, let's say, semiconductors, don't just buy everything, zoom in. Look at the companies. Who has the best technology? Who has the highest margins? Who has the best management? Pick the winner within the winning sector. This is how you maximize your probability of success. You are surfing a massive wave on the best surfboard money can buy. So, your assignment for this week is to practice both views. First, put on your telescope. Look at the world. Read the news. What are the big shifts happening right now? Second, put on your microscope. Look at the products you use every day. What brand do you love? What service can you not live without? Once you find a company that looks interesting either because it fits a megatrend or because you love the product, what do you do next? Do you just buy it? No, that is gambling. The coup has identified a potential target. But now, we must verify if this target is actually healthy. We need to look under the hood. We need to see if they are actually making money or if they are just good at marketing. We need to look at their report card. In the corporate world, this report card is called the financial statements. In the next episode, we are going to learn a new language, the language of accounting. We will discuss reading financial statements, analyzing corporate report cards. We will learn how to read the balance sheet, the income statement, and the cash flow statement to spot the liars and find the champions. The telescope is down. The microscope is out. I'll see you in the next video.